In modern financial systems, power does not always belong to the institutions people expect. Many assume that markets determine prices, that investors dictate capital flows, and that supply and demand shape the financial landscape. On the surface, this appears true. Markets fluctuate constantly, responding to news, earnings reports, geopolitical events, and economic data. But beneath the visible layers of financial activity lies a deeper force. Liquidity. Liquidity is the lifeblood of the global financial system. It is the availability of money and credit that allows markets to function smoothly. It determines whether assets can be bought and sold easily, whether banks can lend freely, and whether economies can expand without friction. Without liquidity, even the strongest financial structures begin to strain. Yet liquidity does not emerge spontaneously. It is created, managed, and controlled through a complex network of institutions and mechanisms that shape the modern financial world. At the center of this system stand central banks. Central banks influence liquidity through interest rate policy, open market operations, and lending facilities. By adjusting the cost of borrowing, they affect how easily money flows through the banking system. Lower interest rates encourage borrowing and spending, while higher rates slow economic activity and tighten financial conditions. Through asset purchases and balance sheet expansion, central banks can inject enormous amounts of liquidity directly into financial markets. When they purchase government bonds or other securities, they effectively create money within the banking system. This new liquidity increases reserves held by commercial banks and encourages further lending. In times of crisis, these actions become even more significant. Central banks often act as lenders of last resort, providing emergency funding to stabilize financial institutions and prevent systemic collapse. Their interventions can calm markets, restore confidence, and ensure that credit continues to flow. However, central banks are only one part of the liquidity structure. Commercial banks play an equally critical role. Banks create liquidity through lending. When a bank issues a loan, it effectively generates new money within the financial system. This process expands credit, fuels economic activity, and supports investment and consumption. Because banks operate within fractional reserve systems, they can extend loans far beyond the physical cash they hold. This mechanism allows credit creation to grow rapidly during periods of economic expansion. But it also introduces fragility. If confidence in banks declines or depositors withdraw funds simultaneously, the liquidity structure can come under severe pressure. Banking crises throughout history often begin with sudden shortages of liquidity rather than outright insolvency. Beyond traditional banking, a vast shadow system also influences liquidity. Investment funds, hedge funds, money market funds, and large institutional investors collectively form what is often referred to as the shadow banking system. These entities operate outside traditional banking regulations, but play major roles in credit creation, lending, and market liquidity. Through repo markets, derivatives, and securities lending, they provide essential financing for global financial markets. The repo market, in particular, acts as a critical liquidity channel. In repo transactions, institutions borrow short-term funds by providing securities as collateral. These transactions allow banks and financial firms to manage daily funding needs and maintain market stability. If disruptions occur within repo markets, liquidity shortages can spread rapidly through the financial system. Another powerful force shaping liquidity is government policy. Fiscal spending, taxation, and debt issuance all influence the flow of money within the economy. When governments run large deficits, they inject funds into the private sector. When they issue bonds, they absorb liquidity from financial markets. The interaction between fiscal policy and monetary policy creates complex dynamics that determine the overall availability of liquidity. Global capital flows add another dimension. Large institutional investors, sovereign wealth funds, and multinational corporations move capital across borders in search of returns. These flows influence exchange rates, asset prices, and financial conditions across multiple economies simultaneously. A shift in liquidity conditions in one major economy can ripple across global markets. For example, when interest rates rise in a major financial center, capital may flow away from emerging markets toward higher-yielding assets. This can tighten liquidity in developing economies, leading to currency depreciation and financial stress. Technology has also reshaped liquidity dynamics. High-frequency trading firms, algorithmic trading platforms, and digital exchanges have accelerated the speed at which capital moves through markets. Liquidity can appear abundant during normal conditions, but vanish rapidly during periods of stress. Modern financial markets are highly interconnected. A disruption in one segment of the system can quickly cascade into others. Liquidity shortages can cause asset prices to fall, triggering margin calls and forced selling. This selling pressure can spread across markets, amplifying instability. These dynamics reveal an important truth. Liquidity is not simply a background condition of financial markets. It is a central force that shapes economic outcomes, asset valuations, and systemic stability. Those who influence liquidity hold immense power. Central banks set the tone through monetary policy. Banks and financial institutions expand or contract credit through lending. Governments shape liquidity through fiscal policy, and global investors move capital in response to changing opportunities and risks. Together, these actors form the complex network that determines how money flows through the global economy. For investors, understanding liquidity is essential. Rising liquidity tends to support asset prices, encourage risk-taking, and stimulate economic activity. Tightening liquidity can have the opposite effect, leading to volatility, declining valuations, and financial stress. Many of the most dramatic financial events in history, from market bubbles to sudden crashes, can be traced back to shifts in liquidity conditions. When liquidity expands rapidly, markets often surge. When liquidity contracts unexpectedly, the consequences can be severe. Ultimately, liquidity is the invisible architecture supporting modern finance. It determines whether markets remain stable or fragile, whether growth continues or stalls, and whether crises spread or fade. Understanding who controls liquidity reveals a deeper layer of financial power, because behind every boom, every crash, In every financial transformation lies a single underlying force: the flow of money itself. Welcome to Cash and Chronicles, where money, power, and history collide.